Good morning, everyone. Over the last several days, investors have been asking the same question. Is this the beginning of a market correction or something bigger? My view is actually pretty simple. The market isn't crashing, it's repricing reality. Over the last 18 months, we've witnessed one of the most powerful rallies in modern history, driven largely by artificial intelligence, technology, and investor enthusiasm surrounding the future of automation. That optimism isn't misplaced. AI is real. The opportunity is real. The transformation is real. But eventually, every market has to reconcile optimism with economics. That's exactly what we're beginning to see. Last week's job report came in significantly stronger than expected. The labor market remains resilient. Economic growth continues. Under normal circumstances, that would be viewed as a positive. The problem is that a strong economy also means inflation may remain elevated longer than investors expected. And if inflation remains elevated, the Federal Reserve may be forced to keep interest rates higher for longer. That's what markets are suddenly paying attention to. At the same time, we're seeing oil prices move higher as tensions between Israel and Iran continue to create uncertainty throughout the Middle East. Energy matters. Energy impacts transportation, manufacturing, and inflation. And inflation impacts everything. Now, add another layer. We're entering what may become the largest IPO cycle in modern history. SpaceX is preparing to go public. OpenAI has confidentially filed for its IPO. Anthropic has already filed. Meta, Microsoft, Alphabet, and others continue investing hundreds of billions of dollars into AI infrastructure. That capital has to come from somewhere. Investors are beginning to realize that AI isn't just a technology story. It's a capital story. And those capital requirements are enormous. Meanwhile, we're seeing signs that consumers are beginning to feel the pressure. Recent surveys show more households reporting financial stress. Interest rates remain elevated. Credit costs remain elevated. And while the economy remains strong, cracks are beginning to emerge around the edges. What does all this mean? It means we're entering a market environment where selectivity matters. The easy money's already been made. The next phase will reward discipline, risk management, liquidity, structure, cash flow, and lastly, realistic expectations. One of the most important lessons I've learned over the years is that investors often misunderstand risk. Risk is not simply volatility. Risk is not simply whether an asset moves up or down. Risk is the probability of a permanent loss of capital. That's why disciplined systems matter. That's why structure matters. That's why understanding what you own matters. The investor who navigates the next phase successfully won't necessarily be the ones chasing the hottest stocks or the latest headlines. They'll be the ones who understand how to allocate capital intelligently while protecting themselves from unnecessary risk. At Celtic Capital Group, that's exactly how we view the world. Preserve capital first, grow capital second, because opportunities will always exist, but only if you're still in the game when they arrive. Here at Celtic Capital, we structure capital, we build intelligent systems. Thank you for watching.